Well, Kevin, welcome back. We got a lot that's happened since the last time you were on. In particular, this week we had some data points that came out. Number one, CPI came out, and then the PPI, the Producer Price Index, came out. Why don't you tell us what happened? What is this saying? What does this mean going forward? Lots of people confused about it, by the way.
Sure. So the report came in hotter than expected.
Okay.
Came in at core CPI, which is what I think most of us are really watching. Core CPI came in at 0.4 for the month. Year over year, 3.8%. And then, as we've said several times, that the adults in the room that look at that report will look at the 3-month and the 6-month annualized for a better read on inflationary trends. And the 3-month came in at 4.3%.
So basically to the upside, surprising many, right?
It's not what the Fed wanted to see. So the expected reaction then was, well, maybe this is bad news. But instead, the market, especially the long duration assets like tech, actually rallied.
Correct.
It's not normal. So what's the read through on that? And there's several, but the view I've sort of centered around is that maybe rates really aren't that restrictive. Economic growth and earnings have surprised to the upside.
Very true.
So why is that? And maybe that's what the markets and particularly the big rally in cyclicals. What is that saying? Well, we talked about it before the show, market liquidity has actually increased since October, which is not consistent with a rate hiking cycle.
Correct. When you're trying to restrict.
Right. And as we can see on the chart, financial conditions are still looser now than they were when the Fed first started hiking rates. That's not the idea at all. And then, of course, we've got 6% deficit spending by the government, which is a huge tailwind to growth.
Yes.
And, they're kind of, you go. It's like, where's the best balance sheets? Where's the best place to be? Well,
we've gone from 6 years to $1 trillion in debt to, I think now it's 6 months to get to $1 trillion. If that tells you anything at the pace of liquidity that we've seen out there as far as deficit spending. But, you do point out, Kevin, we're now seeing increased liquidity. The whole point of trying to restrict inflation, raising interest rates, was to restrict that. And remember, one of the things we've been saying for years, and I know you've been pounding on this as well, it's the liquidity that matters. That's what drives the market. There's probably a big reason why you saw gold and why you saw Bitcoin and some of these safe play assets go higher is because, again, that liquidity went higher. So,
and it's not just the Fed put these days. It's also the Treasury put. And Janet Yellen doing her part.
Yes, and the issuance of shorter-term paper, right?
Disproportionate amount of T-bill issuance, which is a big bet that rates will come down. And we just had a 10-year auction yesterday that did not go well. And these 10-year, 20-year auctions have been very much hit or miss. As people look at our deficit, the expected deficit going forward, and they go, do I really want to own 10-year, 20-year paper? And I think increasingly the answer is going to be no, because there's no political appetite on either side of the aisle to restrain spending. Look at all the earmarks that went into this latest bill to extend the budget.
Oh, absolutely. Well, you could spend probably weeks looking at what went into that bill. Well, one of the things is that the Fed came out, and we talked about this at the beginning of the year. The market was priced for perfection, right? We had 6 rate cuts priced into the market at the beginning of the year. You can probably let us know what that's changed to. But that was something I think you and I were both like, it feels too good. Something's got to give. It's not going to go the way it seems. And that's always corrective markets. Always expect the unexpected. But where is now the expectations of rate cuts, and what is the ramifications for that maybe for some companies that price perfection in?
Yeah, so the expectation now is maybe just 4 cuts this year.
Okay.
But despite the hot print yesterday, people are still saying, yes, the Fed should go in June. And I'm looking at it, they're like, let's see why.
Yeah.
And they're nitpicking, a lot of people, nitpicking the components of the CPI index, which you should do. But what I didn't hear enough talk of, in my view, was oil prices. Which can change everything. And oil prices are up about 8-9% on the year, and the leading indicators that I look at for the energy complex have been improving now for over almost 3 months, which is indicative of, all else equal, a higher level of oil prices. And, we've seen a deficit in, or rather decline in gasoline inventories, which suggests higher prices. So as I look at it, I'm not in the four-cut camp. I think inflationary is going to stay, and continue to say this, will moderate in somewhere in the 3.5 range, and stay sticky in that range. The move to 2% is probably going to require a hard landing.
Well, I think that was a surprise to many, is just how sticky, and especially services, has been as far as inflation. And even if some things are commodities based, they come down. You think, like for instance, groceries and stuff. You think the prices would come down? Nope. They're not coming down. Services, you think they're ever going to see service prices come down? No. If anything, maybe we don't see prices raised before a long time, but that initial increase is what we're all feeling. Maybe we don't see price increases in the future, but bottom line is, they're not going to come down anytime soon. No,
and the expectation by the Fed was, for disinflation, which is just a slower pace of price increases. And we'll see. It's the categories that were hot in January were not as hot this month, so there's a rotation, and the market chose to look at that as a glass half full.
Yeah.
And the market just it wants to be in a bullish mode here. Well, good news is good news, and bad news is also good news, because then the Fed is just that much closer to rate cuts.
Well, one thing I'll remind everybody is inflation comes in waves, that first one being the biggest, right? We're going to see subsequent waves. I think it's foolish to think inflation has one big wave and it's done. I don't think we've ever seen that in history, so why expect that now? But I do think it's probably going to gradually, taper off, or it'll flatline for a good while. It's not going to be as fast as the Fed would like, or many would think, is what we're kind of seeing right now. But let's talk about this market. I mean, it has been resilient. I think everyone has heard of the Magnificent Seven by now, and they just continue to defy gravity. And it tells me, this market is so momentum and sentiment based that fundamentals really kind of take the back seat. And Kevin, one thing I want to ask you is, you keep hearing, and everyone's out there keeps pointing, well, this looks a lot like 2000, right? I mean, we've heard that all over social media, everywhere else, news at the CNBC. But kind of maybe break down what is this time, and how does it really compare to 2000s? What's some similarities and maybe some differences there?
Sure. So 1999, 2000, it was all about the internet and just the potential growth from that, and what could it be?
Correct.
And valuations were exorbitant at that time. Balance sheets of those top companies were not nearly as strong. And I believe I saw in an early 2000 report that the top 5 companies in the S&P 500 accounted for 102% of the return that year. And it was all about tech. And, what's the next stock to go to 200? This time around, the Magnificent Seven, and just more broadly through the tech sector, at least within the S&P 500, the valuations are not, they're about half of what they were.
Okay.
And the balance sheets are significantly stronger. So the Magnificent Seven have had a huge run. They have dominated the market. We've got a chart to show the disproportionate returns on the Mag 7 versus every other asset class, basically.
Exactly.
So diversification looks like it's not working here, at least broad diversification. But there is now a pretty good amount of what I'll call dispersion within that Magnificent Seven. 3 of those stocks are down on the year, and 2 of them underperformed the S&P 500 over the past year. When we see a group or a sector of the market really dominating, and then you start to see some dispersion, some start to fall off the wayside, that's oftentimes indicative of a trend change, a rotation in the market. And we may be going into that type of a phase, but I don't think it's as dangerous for technology overall as it was in 1999, 2000.
Where are we seeing that shift? I mean, as a matter of fact, I don't think tech is the fastest or the best running sector for this year, but where are we starting to see a shift somewhere else?
So along with that, then we've talked about it before, hoping the market would broaden out.
Okay.
Well, guess what? We saw it within cyclicals.
All right.
Cyclicals have traded relative to defensives like it was 2009, 2010, right after the great financial crisis, where there was just a ton of liquidity thrown at the market, fiscal stimulus as well. That was the time to own cyclicals. It's almost that dramatic now. And those are more short cycle type of asset classes. So I would argue that rather than so much the Magnificent Seven, it's probably more the cyclicals that might be more extended over their skis and subject to a sharper pullback if there's a slowdown in growth.
Well, no, I think that's a good point, and you did say one comment I want to come back to is, the Magnificent Seven has done so well, you're starting to hear out there, people are saying, well, why diversify, right? Just own the Mag 7. And you and I have been in the business long enough to know that when you get to these points where people start to say, hey, this time is different, just go into these, that's usually a time where that rotation change happens. And I'm not calling for an ally crash or anything like that, but I think it's a dangerous statement to come out there and say, don't worry about diversification. You and I know if there's one hedge against uncertainty and the unknown, which we're clearly in, we've got more geopolitical risk going forward. The one saving grace, back to what Markowitz talked about, is diversification. And I don't think steering off that, and when you hear people talk to you about guiding you off that, that's usually a red flag in my opinion. What are your thoughts there?
I'm right there with you.
Okay.
And, within that Magnificent Seven, now that we've had a couple drop off, now it's like, well, you should really just focus on those that are most connected to or most leveraged to AI. So now you have NVIDIA and Meta.
Yeah.
And those stocks now doing dramatically better than the rest. And yeah, that's another red flag. When that starts happening and you start hearing that among PMs in the business.
Absolutely.
It's easy to get caught up in the emotion of the market. And it tends to draw people in late.
Yes.
Saying, look at these returns, aren't these compelling? Or somebody said, I'm tired of lagging the market here. I want to be in what's working.
And that is the danger. And you and I will always say you might do some rotation, but always stay diversified. That tendency to go throw it all on black is not going to be a winner in the long term.
And another acronym that has come out recently is the Granolas.
Okay. All right, fill us in on what that is.
These are European companies, 11 of them.
Okay.
That are growth compounders, strong balance sheets, high sales growth, reinvestment in the business.
Okay.
And these 11 companies account for about 25% of the market cap in the European stocks 600.
So not as high as our Mag 7.
Correct. But as far as the diversification angle, playing to the same dynamic in that, strong companies, you heard me say high quality
yes.
a million times. It's basically the high quality way to play Europe. I've said for a long time, I think Europe is a mess, and I think getting even worse structurally, especially after the war, even more so.
Yes.
Different subject, but you can cherry pick those international companies.
Strong brands.
Focused companies that are just based in Europe as another way to add diversification. Without just doing the index.
So Kevin, actually, final thought. We're talking about diversification. We're talking about the Mag 7. You talked about the granolas. You kind of introduced that to everybody. What are maybe some last thoughts on diversification that people could be thinking about?
So I think, as I mentioned before, the higher risk parts of the market here might actually be cyclicals.
Mm-hmm.
So adding more of a defensive component to the portfolio. These are companies like Staples, healthcare, might on a valuation basis look a lot more attractive, certainly have lower volatility. I also think that if the Fed wants to cut, they want to, and it almost seems like they will start even if the data doesn't quite support them. If they do that, there's a case to be made for a weaker dollar. If that happens, then that gives an extra leg then to international stocks and also energy, which I think could be an attractive place to look here as well.
Well, Kevin, look, as always, expect the unexpected, and thanks for coming on, and we have a lot to talk about in the coming shows.